Okay. Well, good afternoon, everyone. I appreciate everybody filling in and having a full room for this, what hopefully is a lively conversation. As kindly introduced, I'm Rob Morocco. I'm the global head of ETFs at the Texas Stock Exchange, and I'm really excited about the conversation we're about to have. So maybe I'd ask Paul if you want to kick us off and just introduce yourself and the indexing
Sure,
firm you represent, and we'll take it from there.
absolutely. Good afternoon. My name is Paul Starkey. I'm from a company called Index. Indexes is my whole company. Index. I've been, people that know me, I've been around in the industry for a long time. Really, my passion is kind of the intersection between business and technology. And I've been very, very fortunate in my career to be able to fulfill that passion through indexing. I've been connected to a number of companies, one called Indexes, which is now the London Stock Exchange, and also a company called Mergent, which is actually Indexes is with the NASDAQ and Mergent is with London Stock Exchange now.
My name is John Angelos. I work for Mercube. My responsibility is client relationship management and business development, primarily working with ETF issuers and sub-advisors in North America. For those of you who aren't familiar with Mercube, we're an index provider. We were founded about 5.5 years ago from two gentlemen that were senior executives at S&P. And really the impetus for our origination is what we've been talking about all day today. It's the trends that were currently evolving back then, where strategies were going from very simple to complex, passive to active, where more of these strategies were becoming increasingly complex, using derivatives in some capacity, either for hedged equity, income generation, or a combination of the two. We're working with many of the largest ETF issuers in the defined outcome space. We most certainly can slice and dice the S&P 500 every which way, but really I would say we cut our teeth in the more complex rules-based strategies where we use derivatives to create these indices. So having said that, looking forward to the discussion, hoping that I can provide some unique insight given where I've sit my experience thus far in this space.
Bruce Tran. For those that don't know me, I'm a global head of indexes for DXFeed. And so DXFeed is at its core a global market data aggregator. So we provide financial technology solutions as well as index management solutions for global market participants around the world, including institutions, financial exchanges, and just global players for that matter. But in terms of my background, I've been in the index industry for over 20 years now, longer than I anticipated. But had the privilege previously of incubating SIBO's indexing business and worked on and onboarded a number of their derivative strategy benchmarks, including a hot topic today. It seemed the first batch of target outcome indexes about a decade ago. So, but looking forward to the conversation today.
Ryan Giannato. I'm with the London Stock Exchange Group, FTSE Russell. I've been here for about 4 years. I'm manager of equity index research, and that really covers everything from identifying market opportunities, building out the strategy, and then going to launch and commercial support onward from there. And it's a really exciting time in the industry. We're seeing all sorts of new tools hit the market to sort of continue this relentless onward march of indexing into asset management. So it's going to be a great conversation.
Well, let's start that march then. So first topic, wanted to take a look at almost a year, 18 months in from the first digital asset ETFs coming to market in the US, had been in market in other regions around the world. Paul, both your firm and Ryan have benchmarks tracking some of those products are tracking those benchmarks. Now that I would say more and more we've seen the adoption of these products becoming more mainstream. What does product 2.0 look like? Where do we go from here? Where does the adoption continue to look like? And maybe Paul, we'll start with you.
Yeah, sure. It's a great question. I think the adoption of digital assets is the current products that are in the market are forming the way to a kind of sea change that's happening in the industry. I think there's during my career, I've kind of measure like 3 or 4 times that there's been a sea change. And I think that's actually coming along. And I think the adoption of digital assets and building other products, opening up other asset classes, etc. So I think the existing or the ETFs that are currently in the marketplace are opening that path. And also ETFs that have themes around digital ecosystems as well. We've been managed to build some products on that as well. So that's my thoughts.
So not dissimilar from what we've seen previously around gold and gold miners, and really the buckets and the picks going along with not only the underlying asset, but also the ecosystem around it.
Yeah, I think it's the ecosystem for products, but also the fact that you can begin to put data up onto the blockchain. You change how products are being constructed and put together, the use of AI around those as well, and also the fact that digital assets will trade 24 hours a day as well changes from an index construction perspective. When you think about building products now and thinking about business transformation going forward, then it's not just about, you know, building a thematic index anymore. It's about actually thinking about the infrastructure and the resilience you need going forward now to accommodate digital assets and the characteristics of those assets classes, which are different, plus the requirement for them to trade 24 hours a day. It's a whole kind of different spin on calculating indexes just during the normal trading day.
Ryan, maybe to take it further from, as we've talked about some of the thematic products, some of the products that have come to market, when we think about 2.0 now and what you're hearing from clients in terms of demand from their clients, what's the next flavor of these types of indexes using digital assets that we should expect to see when we look out 12 to 18, 24 months?
Great question. Really, I think we need to make it a lot more institutional friendly. We need to set, basic standards, expectations on how these assets work, create a proper framework. So for everything, like, what is the close price for a digital asset? It trades 24 hours. Which exchanges do we use for data, for volume? So there's just some different things to iron out. It really kind of is a new frontier. It's like commodities trading in the 70s. That's what I think is the best analogy. You got these guys who were, legends in their time, trading, cotton futures, and it's Bruce Kovner. It was just great stories, and it's kind of like we're in those days today. But really, I think the most exciting part is integrating digital assets into broader multi-asset comprehensive portfolios. You can go and own these digital assets in themselves, but I don't really think as an ETF that solves a problem. I think if you want baskets, that's interesting. If you want diversification, a ready go-to package of digital assets, that's interesting as well. But also blending it in, sort of like a risk parity approach, multi-asset, I think that is valuable, because otherwise people can just go to their Coinbase account or wherever they choose to have custody of these assets.
Do you see, and just as a follow-up to that, and you mentioned the basket and now collection of some of those different assets or coins being included and packaged up, and that really kind of being the next wave, where does the current regulatory regime fit in with that? How does that either possibly positively impact those products coming to market, or is there still a longer road till we see those kind of beginning to debut in the U.S. market?
Well, I think it's twofold. One is as an ETF, and then second is establishing, indexes, benchmarks. And I think that is indexes, benchmarks. I think that's going to come first. We're going to set standards, get people tracking these indexes, build the benchmark for if you have a crypto exposure, what should you expect? What would be, a profile of returns? And obviously it's very concentrated. If you think, US large cap is concentrated, crypto is even more concentrated. So just coming out with different frameworks and working with investors is going to be the first step. The second step would be more products. And obviously that's going to have regulatory impacts, but, getting some of the down market assets, online. But, it looks like the market is quite favorable from a regulatory standpoint.
Understanding now, as we've talked about some of the ETFs that came to market, where we're going, as we talk about the entirety of the ecosystem, just the logical next step is that there are going to be derivatives on some of these indexes and on some of these products. And I think that's a great segue into Bruce and to John here to really kind of dive in what we've seen come about now in the derivative form of some of these digital asset indices. Bruce, I know you have some experience with this, and then also John with packaging that up again as an ETF with some of the buffered and defined outcome strategies. So maybe Bruce, where do we see this ecosystem continuing to expand and evolve around digital assets and really around the derivative piece?
Yeah, I mean, it's, building upon that previous panel on marketing, right? It's that story that we're all telling with these products that are coming out, and just really from either from a product issuer standpoint, regulatory standpoint, and the client, right? And so just getting that education out there. I think we're very early innings on the digital asset space, meaning that there's a lot of education that needs to be had, right? What I mean by that is that when you talk about digital assets right now, there's two items that come up to that: Bitcoin and Ethereum. From a multi-asset perspective, I think nobody really knows what that means. How does DeFi apply to that, and other factors within blockchain and et cetera? So I think we will move towards that direction, and I think we'll move into that at a faster clip than we are right now. And multi-asset is definitely going to be a flavor that when the index providers do launch a portfolio perspective on that, that will push that space, and raise that tide with everyone.
And John, now you have the derivatives out there, you have the asset class. Now, what about building out some of those target outcome or buffered outcome strategies and packaging those up?
Yeah, for sure. That's going to be probably, and it's already occurring. The one issue that we had with one client that wanted to be able to define outcome on IBIT, the SEC imposed position limits on flex options. So, as we looked at the strategy itself, and if this strategy were to gain any kind of traction, we would have exceeded that position limit, in a heartbeat. So that was unfortunate. So unfortunately, the client had to go in a different direction and create a workaround, which they were able to do, which was great. But what we're seeing right now is still this learning curve that the SEC and even investors are really still moving out on. So there's a degree of comfort or lack thereof still, particularly by the regulators. They're concerned about liquidity and volatility, and understandably so. So we're not there yet. So there has some work to do with the ecosystem before we can fully embrace defined outcome type strategies with the usage of derivatives in a broader sense.
And so, John, you had painted that story there with a previous client and really some custom work. How does typically the custom indexing work, especially on the derivatives end, supporting some of these bespoke products that, yes, they are systematic in nature, but they're actively managed? How does that fit in with an index provider?
Yeah, so we're very involved in this space. Being a new startup, we don't have a whole lot of off-the-shelf type solutions. We're really working one-on-one with clients in a consulting, advisory role, where they're coming to us with either a fully baked methodology or a concept and a whiteboard, and we'll sit down and work through all of the nuances to create a formula and a calculation about the strategy. Having said that, I'm going to just bring up defined outcome because I think that is a prime example. It's very topical. So when we look at a defined outcome strategy, and most everybody understands what that is, at least to a certain extent, the bottom line is all this strategy is trying to do is reduce portfolio insurance to basically zero, which is much easier said than done. So when you look at the strategy, it is nothing more than a basket of options, and these are not standard options; they are custom options called flex. So as an index provider, what we want to do is say, okay, we've got this strategy. We want to give you exposure to a market, which is actually done with a zero strike call, which is probably what most people don't even realize. That's a Delta One linear payout, very similar to getting exposure through SPY or some other type of ETF. We then will have a predetermined level of protection on the downside. And that's, as I said, predetermined 5%, 10%, 15%. The challenge comes in when you want to solve for X and sell that call to fully offset the cost of protection. Because if you don't do that and it's unfinanced, it's not financed, you can easily sustain a 1% expenditure per month to run that hedged position. Obviously, that's going to be a pretty significant drag on performance. So we want to be able to mitigate that, or at the most, eliminate it completely. So here's where the complexity comes in. You want to be able to find out what that put is going to cost, then figure out the call that you're going to be able to sell in order to offset that expense exactly. You can't do that with standard options, because when you look at standard options, these are predetermined strikes. They're not very granular. They could be 5 index points between one and the other. So if you sell a call that is too low, relative to the underlying, the at the money, you're going to generate an additional credit, which is great. The problem is the trade-off is your cap is going to be much lower. On the flip side, if the call is going to be too high, you won't fully fund that position and you'll have a drag on performance. So when you solve for X, the odds are almost 100% you're going to fall within the standard strikes. And that's where a semi-customized options comes into play, where you can pin that strike specifically to fully have a zero net cost to that strategy. So what we have done as an index provider is we have gone through history of options prices and created our own historical implied vol surface from 2005 onward with the typical names SPY, IWM, QQQ, to create these customized standard option prices so we can put this package together. So having said all of that, what's the value added proposition that an index provider does with these complex strategies? And it was really discussed in the previous panel. It's about marketing and telling a story. We're part of that story. An active ETF issuer does not have to use a benchmark. They're not required to be tied to a benchmark. But what we can do is through our back test, we can create a hypothetical portfolio that depicts the performance of that payout stream during different economic regimes. So that can be used to educate the educator, the RIA, so they can fully understand this complex strategy, take that story to their investors, explain to them what this strategy is intended to do, and hopefully that helps them accumulate assets. So that's the story and what we do in our value-added proposition, working with these complex strategies and the ETF issuers. It's to make the story more digestible to help them raise assets.
And democratize the strategy. Not dissimilar from structured products that have existed for years and years. This is
exactly right.
Just utilizing the vehicle for democratization.
I'm sorry. I was just going to add on to that, since you brought that up. When you look at where these defined outcomes came from, as Rob mentioned, they've been around for a long time. They've been in ETF, they've been in structured products, they've been in the hedge fund space. You want to allocate to a hedge fund, it's going to cost you 2 and 20. It's going to be 200 basis points and 2%. It's exorbitant fees intended for the highest net worth individuals, $1 million minimum to get into those strategies. Structured products, it's not going to be as costly, but those expenses are opaque and they're embedded in the spreads, also very costly. So in an ETF wrapper, you're going to pay 60 bips, maybe a little bit more. They're transparent and they're liquid. They're tradable in the secondary market. And it's a great wrapper for those type of products geared towards a retail audience, which were never able to get access to it before.
Yeah, and I think that's really the space we see ourselves in, carving out, active capabilities in an index using sophisticated data to provide new exposures and sort of come up with a 90% solution of what hedge funds are doing, what they think they're doing, trying to do maybe, and do it cheaply, efficiently, at scale. And that's really the types of exposures where we see, whether through factors, tranching out different types of risk, and volatility as well. We can implement sort of, and there's strategies that work very well in this area, and there's strategies that don't. For instance, macro data as a market timing signal generally doesn't work very well. But there are others that lend themselves very well. Looking at different academic factors, looking towards AI to digest different patterns. And that's an area where we're quite active in rolling out, basically designing, testing many different new hypotheses. And, that's sort of the real future of indexing. There's a lot of flash in the pan about digital assets. I mean, it's nice, but it's basically a two-stock market. The real change is what's happening to large caps over the long run and how we trade them with increasing sophistication and capability at scale, but at low cost as well. So if we can deliver, this high-powered hedge fund-like strategy at 5 bips, that's really where we see the industry going and where we're investing ourselves.
And to expand on that, Paul, I'd be curious, as we've discussed here, that line of active and passive being blurred, regulation changing for ETFs with 6C11, and where, again, a lot of those structural, very clear differences between an actively managed fund, a passively managed fund, begin to blur those lines a little bit. Where do you see the role of the indexer here?
Yeah, I see, just backing up a little bit on the digital asset side of things, then One of the conversations that I'm having quite on a regular basis now is not necessarily derivative products, but blending crypto with other asset classes. So blending it with equity, or one of the conversations that's come up almost on a daily basis as I go and meet asset managers and people looking to build products is crypto and fixed income products. So we're actually looking for some sort of yield risk type product that is incorporating crypto into the products as well. As well as I think it opens up, you said about, I think from a regulatory perspective on digital, I think the regulatory environment is becoming easier. I think the fact that certain legal cases have been cancelled shows there's a willingness to move forward and be innovative in that space. As it comes to active products is actually interesting. I can relate it to when I joined Index, which I joined in September last year. Then I went into our CRM system and we had active asset managers, and basically we wouldn't contact them because we said they didn't need an index. I think that line is now blurred much more now. I'm finding that in conversations that we're having when we build benchmarks or thematic products or any rule-based index for these clients, that they're saying, can you build us an index in which we can pick from? So therefore we're supplying them with a benchmark, etc. And then they use that as their starting universe for actively managed products. Or if they have a particular themed actively managed product, then what they're actually looking for us to do is provide a themed benchmark for that as well. So I think there's now a blurred kind of line between the two. And there is, for the conventional kind of custom index firm now, I think they can actually play in the active space.
That's a great point, and I would go even further. I would say that the division between active and passive, not only is it blurred, I would say it's an outdated paradigm altogether. Maybe in 2015 we could have that conversation, but the reality is the division now is between systematic and non-systematic. And that's what we see, because honestly, index strategies, methodological rules-based strategies, can really take on all types of active exposures. We're really pushing the frontier there. And I think the great irony is these active strategies, that when the vol hit at the beginning of April, when they're forced to liquidate, suddenly they're passive. They're kind of held hostage to being forced to liquidate and sort of cash out. And I think that is what's really, really funny. The supposedly passive strategies actively manage their exposure through the vol, where the active strategies, a lot of them kind of blew up. And it's just this great tailwind into indexed strategies for the long run.
Just to add on that real quick, is that if you look under the hood for active, right, it's essentially a passive strategy with some discretion for the portfolio manager, right? And so they're allowed and able to make some discretion on their trades, and even for defined outcome, that seems to be the case as well, right? So essentially, it's a packaged option spread. You put it in and you roll every year or monthly, depending on the strategy, and you're allowed to make these discretion. But overall, if you are going to try and promote these products, you should have an index or a benchmark that defines a true benchmark for what you're trying to achieve, right? And so I think that's an important criteria there that a lot of people miss when they say, oh, it's active, we don't need an index. But in reality, if you're trying to gain more AUM, more sales, I think having that index as a marketing tool is beneficial for everyone within that ecosystem.
Maybe just coming back to derivatives for a moment, as John's pointed out, a lot of the target outcome, defined outcome products that have come out by some really large and small issuers alike. Bruce, where do you see product 2.0? We've seen some products like the box trade come out wrapped up as an ETF. What do you see as the next set or flavor, so to speak, or strategy that embeds derivatives into the portfolio?
Yeah, I mean, from my perspective, I view things as in two verticals. One is slight pivots from where we are right now, and then we look towards the future. What is it, 2.0, 3.0, right? So if we look at the pivot from where we are right now, it's more in the line of custom, right? How can you provide, direct indexing and slight tilts within a portfolio? There's a company called Syntax Data currently right now creating a direct indexing platform, right, to create more customized indexes on the fly. Pretty innovative, right? And when you look at the modern investor right now, they have more information to make a more informed decision, meaning that they're going to want to make transitions or investments based on their own investment goals, right? And so I think we move towards that direction where there's more customization, but you have to do it very smartly and very timely and efficiently. Now on a 2.0 or 3.0 multi-asset, we're looking things at incorporating, digital assets within a portfolio. We're looking at other streams of different market risk and trying to bake that in. So, when you have this correlation risk for your portfolio, how do you properly hedge that? At DXFeed, we're working on a number of innovations in which, I don't want to put too much out there because it's not public yet, but we're working on things so you can now hedge against rising AI, rising computing costs, working with freight, shipping, and cargo, so you can try and hedge those risks. And then working with, as well of digital assets on a multi-asset portfolio approach. So yeah, I mean, it's a lot of things that will come, but multi-asset is a theme that I think pushes forward.
A great segue into AI, right? And granted, I know buzzword and kind of just a few different ways we can take this conversation, but I'd love to understand at a high level, maybe to start, how are each of your firms or thinking about holistically utilizing AI to optimize existing products, optimize existing indexes you have in place, and how are you applying that towards new index construction? How is that finding its way into not only supporting your current business, but also building out next generation products? So maybe Paul, we'll start with you.
Sure,
kind of begin to open up for general
again,
conversation.
a great question, and very topical in regard to the future of indexing, because I think it's going to become a very instrumental part in the construction of indexing going forward. And so, you look at various platforms that are out there that, say they create indexing from AI, et cetera, those kind of things. And I think what they really are is an enhancement to the construction of indexing. I don't think they're going to fully replace, humans building indexes. And I can kind of, we built a product recently for Grayscale called the Bitcoin Adopters. And there wasn't a data set out there. So really, when you use AI, you have to have some kind of data set for the AI to work off of the models, et cetera. So there was not a database of Bitcoin adopters, corporations that were using it for treasury functions. So as we were going through building that product, I was thinking, how would this work in a AI environment? So I think there's two aspects to incorporating AI into indexing. One is obviously an assist to building the products, running the processes and the procedures that we are kind of human, demanding. But I think there's another which really comes to the future in creating unique indexes as well, is that you have to come up with unique data sets. So data sets that are really outside of the scope of the normal commoditized data that you would buy. You have to go out and find and mine that data. So for instance, one index that we've been trying to work on is fairly topical, made in America. You cannot find data.
Those factors.
Yeah. Where do they exist? They don't exist anywhere. So therefore, if you can build an AI model to go out and go through news or written articles and try to put that data together, so therefore, that's where I think AI really sits going forward, and building indexes on that basis
So earlier I said that Mercube basically does most of our indices on demand, custom solutions. We do have some off-the-shelf solutions. We partnered with Queensfield that has a suite of AI indices. And they're your typical, their momentum, their factor, their theme based. They're using market sentiment to select portfolios. Having said that, I kind of liken AI to the early days of crypto. That there are a lot of people that are very curious. It's incredibly topical. They're kicking the tires, but maybe they just don't trust it just yet because they're not sure exactly what it is. So when we're talking to end users about AI and incorporating a strategy around it, it seems like the information, the content falls a little bit short because these AI programs are considered almost black box, that a lot of these managers don't want to give away the secret sauce completely. So when it comes to selling a strategy, especially to retail clients, it's got to be understandable. And these strategies, I believe there's a huge leap of faith that if you want to go in and say, here's my money, this thing is going to run and it's going to do really, really well, I don't think they've proven themselves just yet. I think in the institutional space with AI, and you can sit down across from a portfolio manager and literally, this person, you've had a relationship with him, and he tells you, trust me, you're more likely to trust them. But in the ETF space, there's a big disconnect between a retail investor and an ETF portfolio manager. And, I think that story falls a little bit short because they can't get specific enough to explain exactly how the strategy works. And I think it's going to take time. I think, as these strategies are implemented and they show in real time how they do during different economic cycles, I think that's going to help. Right now, I think it's just a little bit premature, and that's why I kind of likened it to the earlier days in the crypto space.
You're right. The transparency issue with AI and indexing is probably one of the biggest hurdles.
Yeah, happy to move on, Rob.
No,
or-
I was going to say, coming back to Paul's earlier part when we started this portion of the conversation around not having all these factor sets and being able to deploy AI to create some of these factor sets. And I think Ryan and others have begun to chip away at it, but are there embedded risks here? We clearly see the opportunities, being able to uncover vast amounts of new factors and different elements when creating index construction, universes, methodology. And I think we're getting there, but I'd love to tease out a little bit more, that risk versus opportunity
Yeah.
from an index construction perspective.
Yeah, I mean, when you're building out your models, obviously, if you are using AI, your disclaimer here is that if you are using a public AI platform and you're putting in proprietary themes, factors, or what have you, it's going to go in the public domain. So if you are setting up a process for this, I'd highly recommend setting up a working group internally or a governance committee that just makes sure that you are going through the right governance procedures, right, just to mitigate some of these risks. But with that said, an item here to think about as well is that garbage in, garbage out. So the answers that come out, it's pretty much going to be dictated by one, the quality of your question, but then also two, the quality of the data that trained that model, right? And right now, I think to John's point, we're very early stages and we don't know if those models are correct. At DXFeed, we have our own enterprise AI models in which we train with our HDL, which is our historical data lake. It's over 20 petabytes of historical data. And so from our use point, we're confident in the models that we use because we use scrubbed and clean normalized data. And so from our standpoint, we view it as a tool, but as a full complete tool, I think it's a bit early.
One of the things I find exciting about AI is you think about the construction of indexes, and again, everybody's looking for some unique play on indexes. When I go and meet clients, then they say, "Paul, bring me something innovative that's client focused on our particular sleeve." Everybody probably hears that 10 times a week. So the one thing I like about AI is one of the ways that I view data and data across indexes is that I'm agnostic to whatever the asset class is. I think of it as data because that's what it is. It's data. And so therefore, I think one of the things that when you think about AI, it takes away the constraints of the rules and the things we've built around our data sets, like, categorization, sectors, and those types of classifications. And if you think of AI just purely looking at the full landscape of data, financial data, then it allows you to find unique plays within that data that you wouldn't find with the normal constraints of kind of sectors and categories and the things that we all start from. So therefore, you'll end up with, probably some additions to your index that you wouldn't normally capture by using AI. Yeah, it's early days, but it's a moment away from being here tomorrow. It's some of the systems I've seen are very, very close to being able to build a fully transparent product that you could put in front of the SEC and you could say, okay, anyone could replicate this if you have the following data. And so therefore, that's one of the things that excites me about AI is taking away all the constraints that we've built around data today.
Yes, and but what we're doing is we're probably incubating about a half dozen different applications, methodologies using AI in indexing, and it's really interesting. One of my favorite possibilities is, looking at, earnings calls. There's studies that show that humorous CEOs outperform on earnings calls. And, it's just these sort of pattern recognitions that can be blended in. And that's what AI is really good at. It does a few things very, very well. It's good at coding, it's good at pattern recognition, and it's good at data scraping. But I also think it's important to take a measured approach. The story of ETFs has been a history of incremental wins that have compounded, since about 2008, really in earnest, that have produced these momentous gains for investors, for allocators over the long run. And I think that's the mindset to take here. That we shouldn't expect any generational changes overnight. That's not what the finance industry is. That's not what the asset management industry is. The reality is we all get up every day and still go to work. We're all here right now in New York working. AI hasn't negated that yet. The fact is, I'm here with you guys, all of us together. I'm definitely not on a beach in Brazil or skiing in the Chilean Andes. That hasn't happened yet, but, maybe in a few more years. So really, I think it's a mindset of incrementalism, and also the transparency. I think getting around that black box sort of problem, that's going to be the key hurdle.
Last question on AI for the panel. And we've spoken about the application of AI specifically on that investment objective, going through that ideation process of creating a new investable objective. What about on the operations of your business? When we think about, again, the portfolio construction, the daily operation, the back testing, the actual nuts and bolts and the mechanics, does this now mean I'm getting a back test in a matter of hours, days? Does this cut down some of those previously long wait times? What does this do operationally for the indexing industry and for indexers from an operational perspective? Before
Yeah, it certainly can. It reduces the amount of hours to do the tedious side of index creation. But I don't think one, you have to evolve how you put those, use AI. We use AI to go out and scrape data, to collect data and do those kind of things. But from an operational perspective at this moment in time, then we use it more as an enhancement to creating custom indexes. We use it for some routine Q&A on data, etc., those kind of things, collecting data. We have a categorization system and we use it to go out and categorize from a set of rules. But I wouldn't say it's really AI. It's more machine learning kind of setup at this moment in time.
Yeah, like generic automation, effectively. Yeah, I can just go and update this pitch book. Bam.
Yep.
Yeah.
Exactly.
Setting a role for us, I think if you're looking at it from AI, we set specific roles for our AI agents, right? So if we're specifically saying, hey, you are a quant, I want you to find this because we're looking to achieve this, go through these ream of data, going back 10, 15 years, and I'll spit an answer, in milliseconds, right? And so the time to market, I think, is very key, but I think obviously the quality of the question being asked and the data going in definitely needs to, I would say, a level of governance that should be there, because it shouldn't be used as a source of truth, but as long as you have validations. But if your validations are passing it through it with all greens checked, then yes, then it should be a viable source.
Okay, moving on from AI, as we look to the future, we look at what's on the horizon. 24-hour equity trading on the horizon in the U.S. Several exchanges have filed. It's clear that the SIP is moving towards being able to accommodate a lot of questions still within the equity market structure industry to still be worked out. From a operational perspective, Paul, you had pointed out, when does the trading day start? When does the trading day end? Where's the opportunity from an indexing perspective now with the potential of the certainty that 24-hour trading is coming? Where is there opportunity for new strategies? How does this impact operations? Love to kick this portion of the conversation off. So maybe Ryan, if you want to get us going.
Yeah, I'm very much a skeptic of this. I mean, seriously, if you're up at 3 in the morning, and you can't sleep, that's not the time to go and trade Rheinmetall stock. Go watch Pine Barrens. It's a great episode of The Sopranos. Why do you need to go and trade your stocks at 3 in the morning? I mean, you want liquidity. You're distributing your liquidity. You don't need it. Everyone should be trading. It doesn't solve any problem. Go watch Pine Barrens.
Well, looking at Asian and the trading coming out of Asia and APAC, maybe the US folks, but definitely there's this proven demand, and we're seeing the flow coming today and the uptick in those after hour markets. I'm curious, Paul and John and Bruce, do you take the other side of this coin?
Well, what I would say, and Bruce already, coined this phrase, garbage in, garbage out. So my concern is, as an index provider, you're only as good as the data that you have. And my concern is that trading after hours and US names, will there be some demand? Of course, it's going to probably be thematic. I mean, there's going to be some kind of an event that will cause that. But 99% of the time, it's likely to be relatively illiquid. And as an index creator, what we do is we take data from all of the exchanges and we look at bid-ask spreads. And in many instances, when a market is illiquid, the market makers will widen out their quotes because that's how they manage their own risk when they don't want to be put into a position that they can't get out of or to hedge. So in the after hours, they're likely to be relatively wide. And that's fine if you're taking a midpoint and it's symmetrical. They are hardly ever symmetrical. Market makers skew their bids and asks based on the risk that they're warehousing and how they want to unwind a position. So if you're taking a mid in a bid-ask spread that is wide and skewed, you're not really identifying fair value of that equity or an index. So that would be my concern, in illiquid markets. Now, having said that, we have indices that are futures products that trade 24/7. And they're a different animal. Futures relative to securities, different operational issues. There's also a different clientele that trades gold and oil and US treasuries. There is an audience that trades these products literally around the clock. So then the challenge is, if you have a strategy that is 24 hours, when do you want to have that settlement number occur? And what we can do there is we have our own settlement procedure, or it's our own methodology. We do a TWAP, a trade weighted value, that we can literally come up with a timestamp whenever you want it that day to settle, or you can create your own. But we can do that even though Europe might be trading and it's the end of the New York hour. European hours. It's our end of day. We can come up with a timestamp. But they're two different animals. Futures and U.S. stocks are different. Going to be more problematic from U.S. single name stocks in terms of liquidity.
That's a great point. There's one Brent crude. There's one LBMA gold. The Russell 3000 has a few more names than that. And, our clients are focused about reducing trading costs, going to the ends of the world to try and reduce these frictions. And I'll be honest, this just seems like a way for exchanges to eke out extra fees. That's my take. It doesn't solve any problems at all.
Is it not just part of the growing kind of evolution of our space? And, the subject matter is the future of indexing. So therefore, you've got a generation change in regard to people trading cryptocurrencies 24 hours a day. And there are people that get up at 3 a.m. in the morning and do an arb on the difference in Asia to US. They do that. So is this not just part of the same kind of set of words? Again, if you think about any significant change in any industry, there's always a set of buzzwords that get parked along the way, whether it's digital, AI, 24-hour trading. Are they not all stepping stones to where we will end up ultimately, which is indexes? Everything is tokenized or digitized in some way that's sitting on a blockchain, and is traded 24 hours a day. Is that just saying that, there's 24-hour trading? Is this just not a conversation that ultimately ends up, that's where we'll be? And it will, potentially create liquidity, it will cause issues that we've had in the past with indexes that have different constituents on different exchanges, etc., and they still trade and still work. And so I think the 24-hour trading is just one of those points, which is ultimately we will get to a digital world, which is trading 24 hours a day, sitting on some blockchain, and you can trade it on your phone, in an airplane, wherever you are. It's just tradable at that point.
Bruce, I'm curious from your perspective, and as John has pointed out, there's contracts today and underliers today that and products that are out there trading today on that 24-hour schedule. What from an infrastructure perspective now changes for an index provider to be able to produce that real-time calculation, that real-time, regardless of what that underlier is, but now having that 24-hour availability, price discovery. What does that do from an indexing perspective? Where are there challenges? What are things that are really, again, we see it on the horizon coming. We're not there yet. Still a lot of questions need to be answered, again, around market structure here in the US. But from being able to stand up an index, get that ticking to correlate with the product, what are some of the infrastructure considerations?
Yeah, before I answer that, just to loop back on what Ryan had mentioned about the utility of 24. I think it does matter. Being able to provide, I would say, access for people who want to trade. For instance, in APAC, I was just there last week, and the common theme over there was U.S. risk and then U.S. exposures, right? And how can they mitigate some of those risks on their end? And so, being able to offer a solution where they can trade, although liquidity is an item to consider there, but once there is capacity, I think they should be able to serve that market. So yes, I think that 24/7 or 24/5 or 23/5 is a good thing. Now, in terms of utility and infrastructure, absolutely. When you look at certain index providers right now, they only cover certain regions: U.S., EMEA, or APAC, right? So it's 1, 2, 3.
Yeah, talk about infrastructure.
And so lost my train of thought there. Wait. So when you look at in terms of coverage and exposures there, I think index providers will need to expand and look at it as a global footprint because again, risk is pervasive and there is no geographical boundaries. So being able to offer solutions and infrastructure that's IOSCO compliant, I think is completely necessary, and we need to make sure that the governance and controls are in there.
Sense. We're coming down on the last few minutes, so I'll maybe open up to the audience if there's any questions for the panelists. All right. Oh.
I mean, I think from a practitioner's standpoint on the trading and liquidity side, it's just us solving for what you've built. But for the users out there, for the retail clients, I think the salespeople are pretty good at explaining what the product is supposed to do and why they should want to buy it. But one thing that I have a hard time figuring out on my own or explaining is how does it not work? Like when it goes wrong. Okay, if I bought it, too far into the cap, or and I think that's what people need a better handle on understanding with some of these more complex products is I get what it's supposed to do, but is it always going to do what it's supposed to do? And when it doesn't, how much could it hurt? I just don't know how that gets addressed.
If I can jump on that first, just using defined outcome as an example, when we had launched the first bench or tranches of defined outcome indexes or target outcome indexes, we received little fanfare and pretty much skepticism and saying, why the hell are you using flex options within this package, right? There's no transparency behind it. You put in a trade, you really don't see lit markets or anything like that. It's at the discretion of the market makers on the floor, right? And so when we launched those indexes, it took about 3 years before products started proliferating, and then also all of a sudden timing came into play, right? Where COVID and et cetera came into play, volatility. And so I think timing is very important, right? When you're using derivatives within a strategy, it's important that not all strategies will work in all vol regimes, right? It's specific to one vol regime, a bull, bear market, bull market, et cetera. So I think education is going to be key, and I think the index provider has there's due diligence that we need to do to make sure that everyone's educated on that. If not, then I think everyone loses within that ecosystem. But clearly, there's a lot of education that still needs to be in play for derivatives. But access is definitely there. Now that people can trade pretty actively on Robinhood, Webull, and other platforms. So, but with that said, working and having conversations with the index providers, there should be no question that you should not ask. And we have an obligation to you as a client and customer to be able to answer those questions for you.
John, final thoughts.
Yeah, I agree with you. It's complicated. Now, If you hold these strategies to expiration, they will work as marketed, right? It's predetermined. So the problem is you've got to hold it to expiration. If you were to trade in and out of that prior to that, you know, it may be difficult to understand what your risk really is. What we've developed is a tool that's on our website that actually shows where the fair value is of that basket of options relative to when it was launched. So that should give you a depiction as to your risk reward profile going forward. But it is complicated and people really need to educate themselves to those risks, because from the first day that product is launched, that whole dynamic changes because the market has moved.
Well, with that, we're out of time. I want to thank our audience for being a great audience. Thank the panelists again. Thanks for everyone, and really appreciate the time. Thank you.